Hi, everyone. This is Joe Lay, Miracle Man, with another episode of God and Money in Mortgages today. So, today we're going to talk about the mortgage oath. So, the mortgage oath is some successful and smooth loan process experience. So, we're going to dig into that. This is something that we've created, and every single one of these rules or guidelines is there because I can tell you a story of when someone's closing got delayed or denied because they did not follow this guideline. So we're going to dig in. There's going to be two sections. First, just for time's sake, we're going to do a quick overview. There'll be a few minutes, but then under each guideline, there's going to be a timestamp where you can fast forward if you want to hear the explanation and a story of how that comes into play. So let's dig in here. I'm going to share my screen. And here is the mortgage oath. And we try to make it kind of fun and not too serious, but it kind of is serious because we want you to have a successful loan process. So everyone raise your right hand. During the process, it's very important to the success of your loan to take the mortgage 7x7 oath. So raise your right hand. I solemnly swear that I will not, I'm kind of kidding here, but let's go through these in summary style. So number one, I will not apply for credit or co-sign for anything or have my credit pulled for any reason. Now there can be some exceptions, but not many. So definitely run it by me, but I'm probably going to say no because and then you can fast forward to the future of this video to find out more about that. Number two, you will not pay off any credit accounts or use cash to pay off any accounts. So just don't pay off any accounts because there's things that have to happen if you pay off an account. So again, run it by me first before you do it. Number three, will not buy a car, a couch, or a cat or anything using credit, your earnest money for the transaction, your down payment for the transaction, or any cash or money needed to close. So I'll go into that in more detail later. Number four, will not deposit cash of any amount or make large deposits of $1,000 or more into any of your accounts unless you run it by me first. So number five, so number four, that does not exclude your paychecks. It does not exclude, easily verifiable and sourceable, that's the key word, sourceable money. And this topic is so big that there's going to be another episode fully committed to anti-money laundering laws. So anti-money laundering laws in the United States. That's related to number four and number five. So look for that future episode coming out really soon. But that's why you can't do number four because it could violate anti-money laundering laws and it's not going to go well for your closing. Number five, you will not transfer money between your accounts without first consulting me. Now, again, there's some exceptions on that, but just run it by me. Number six, you will not take cash advances from credit or credit cards or use cash for the down payment for cash to close. So what that means is you cannot use unsecured debt as part of a real estate transaction. You can use secured debt, but here's the timestamp, fast forward to that for more. Number seven, you will not refinance the loan until 8 months have passed after your closing and you've made 6 on-time payments. So both have to be present. Otherwise, there's really large penalties in the thousands of dollars, like $5,000 on average. Okay, so now that's just the first part of the seven. The second part, plus, I'm going to scroll down. I will pay my earnest money using a check and take a photocopy of that check or electronic funds transfer or ACH. from an account that I have approved. So part of the pre-qualification for buying a home, you had to give me your bank statement. So the bank statement that I have said is okay, because there's things that I'm looking for that would make that bank account not okay. So I have to approve that bank account, and then you can pay your earnest money from that account. Number two, you will pay all of your debt obligations on time. Now, this might sound like a no-brainer, but I have to emphasize, make sure you pay at least your minimum debt payments on time, that you're not late on them. It's very important. Number three, I will submit all of the documents requested within 72 hours. So, if we lock in your interest rate and if there's a closing that is scheduled, we're on a time frame. So we can't wait too long when there's a request that's made. If you need help getting documents and if you don't know where to go, I can guide you. So ask me. But anytime my team requests a document, get it to us within 72 hours. Now, some rare cases will be that we need it quick, like within 24 hours, but that's pretty rare. If you just stay with the 72-hour window, then we're not ever going to need to rush anything. Number four, you will e-sign all loan disclosures before 4 business days before the closing. And so there's TRID laws, which is mortgage laws. Number 4 and number 5 are related to each other. So number 5 says you will e-sign the closing disclosure 3 business days before closing, because after you sign the loan disclosures, then you have to wait 1 day, then you can sign the closing disclosure. And the closing disclosure, after you sign that, you have to wait 3 business days before you can close on the home. So, that's just about timing and not missing your closing date, because there can be financial penalties if you do. All right, number 6, this might sound like a no-brainer, but I have a story. You'll see if you fast forward to that timestamp. You will keep your current employment and maintain your current hours worked per paycheck. So don't let it go down. Maintain your working hours. And remember that we will verify your employment with your HR department 1 day before your closing. So you gotta keep your job, keep the same hours work that we qualified you for. So if I qualified you with 40 hours a week of work, keep 40 hours a week of work. Don't go down to 39, don't go down to 38 or anything lower, because the underwriter will ask, hey, why are you working less? And did something change? So then your approval changes. Okay, number 7, you will keep your current or improve, which means lower your credit balances that you owe. And remember that we will check your credit 1 day before your closing. So that means don't open new credit cards, don't start racking debt, don't start increasing your credit balances. In fact, if you just keep making your minimum monthly payments, the balances will go down and you'll be good. And don't add more to the debt. Okay, now this is the second part. So part 2 of the mortgage oath. I'm going to go into more detail with each one of these. And so let's start from the beginning. So number 1, you will not apply for credit, co-sign for anything, or have your credit pulled for any reason. So I had situations where the credit was pulled and then new debt was opened. Sometimes it's not even new debt. One person actually got a car lease. Now it's not a new debt because, it's not a loan, but now it's a monthly payment obligation. And that added $600 a month to this person's payment. Yeah, they didn't qualify for the loan anymore. So don't do that. Co-signing. Yeah, I had a situation where someone co-signed for their child's dorm room, or apartment for college. So, that didn't kill the deal, but it did cause, some extra hoops. But, just run it by me first. And then if you have your credit pulled, it can drop the credit score. So you may be on the verge of getting approved versus not approved, or you could be on the verge of getting one interest rate or a better deal on PMI, or all kinds of factors with your credit score. So if you pull your credit, it can lower the credit score, and it could affect your loan. Number 2, you will not pay off any credit accounts or use cash to pay off any accounts. So when a credit account gets paid off, the anti-money laundering laws could require the underwriter to source where that money comes from. So again, you can watch the anti-money laundering video in the future, but that I recorded in the future, and look for that. But what this means is money that's used to pay off these accounts have to be from verifiable legal income sources. So that's all it is. So they will have to, you'll have to provide more documentation, perhaps. Definitely, they'll have to see the bank statement that was used to pay off the account. And it doesn't matter the amount. It could be a small amount, but if it gets paid off, then it could be questioned. Now, if you pay off something every month and there's a history of you paying this whatever off every month, then that's not such a big deal because there's a pattern there. Now, just make sure you're using sourceable income to pay it off. So an example of sourceable income, really briefly, I go into more detail in the anti-money laundering law video, but it's, things like from your paycheck. It's coming into your bank, direct deposit, you can see it, it's good. Or maybe you get a tax refund from the IRS. It comes in, direct deposit, it says IRS on there, you're good. And there's other ways to document non-electronic income sources, but it has to come from a verifiable source. And number 3, you will not buy a car, couch, or cat, or anything using credit, your earnest money, your down payment, or cash needed to close. So it's very common sense that, well, I gave you a car example already, but it's common sense that if you're buying a house, let's say you're planning on closing on a Friday next week, it would make sense to go to the furniture store, right? Hey, I'm buying a house. I have to furnish that house. I need a new couch. I need a new bed. There's an extra bedroom that in my new house that so I'm getting an upgrade. I'm getting a bigger house. You got to buy stuff, appliances, you name it, a lawnmower, snowblower, whatever. So you're at the home furniture store and you're checking out, let's say it's whatever, $5,000, $10 worth of furniture. And the cashier says, hey, if you apply for our credit line or credit card, you can get 0 interest for 2 years and there's no payment for 6 months. You're like, sweet. Let's do it. And then guess what? Now you have a monthly payment obligation of a few $100s. Now, even if it's not going to start for 6 months, even if it's no payments for 6 months, the underwriter will need to find out how much will your payments be once they kick in, because it's not 0 forever, obviously. It wasn't free furniture. So they need to count that monthly payment as part of your debt to income ratio, which was used to qualify for your loan. So that could decline your loan. And it wasn't me, but it was one of my coworkers had a case where they bought some beautiful furniture, but now there's no more house to put it in. They got declined for the loan. Go get a rental storage unit to put your furniture in, or see if the store will take it back. But that's what happened. And number 4, will not use cash or make large deposits into any accounts. So large deposits, so $1,000 is really safe, really conservative. But let me tell you what the current large deposit thresholds are. Now this can change, so ask me if it has changed. But currently, FHA loans and VA loans, so these are government-backed loans, the large deposit threshold currently is 1% of the purchase price. Let's say your purchase price is $300,000. 1% of that is $3,000. So any deposit that is $3,000 or higher, so 2,999 does not count or lower, but any large deposit of 3,000 or higher will be asked, where did you get this money from? And if it's not clear, if it wasn't like a direct deposit from your paycheck or IRS tax refund or something really clear, then they will ask for, if it was a check, hey, we need a picture of that check and a document stating where it came from. Now that document can also be scrutinized. It can't just be, oh, I sold some furniture and, well, actually that it can be, I sold some furniture, so we're looking for a bill of sale. I sold my car. Well, we need a bill of sale showing you sold your car. We need the check that it came, from the seller, and we need to see it being deposited into your account. So we need the transaction history and bank statements from that account showing that you own the account and the money went in there. So it's kind of a big mess. 401k large deposits, it can be done. It can be used for the purchase. However, it's a lot of paperwork to source. So we need 3 different documents, and then not super easy to get, but it is possible. You can call your customer service department and get that. And number 5, I will not transfer money between my accounts without first consulting my loan officer. So when this has to do with anti-money laundering laws, again, watch that video also. But if money is transferred from one account to another account, we need to see the bank statements from both accounts. And we need to see if it's not on the bank statement, because remember, bank statements print one time per month. So if the transfer happened outside of the statement period, meaning after the statement period, then we need a transaction history printout with no gaps in dates. So we need to see the transfer going out of one account and then in to the other account. So there's in and out, right? So we need both accounts. Now now let me just say, if it's an account that you own, then we need 2 months of full statements. So 2 months of full statements. And then if there's any transactions after the statement cutoff, we need the transaction history printout of that showing in and out transfers of all the accounts involved. Now, if it's a donation or a gift fund that was being transferred, then so gifts are from donors. So it's not a loan, but it's a gift. And a gift does not need to be repaid back. There's not an interest rate. There's not a monthly payment. So that's why we use gifts for real estate transactions. And that is possible. And we do it all the time. But if it's a donor account, we might need 1 month of their statement, of their official statement. And then transaction history after that showing the transfer came out of their account. Now it wasn't me, but it was my office. Somebody else, different loan officer, had a crazy situation that the money was from a donor. And well, actually it started with, hey, show me where this money came from. It was a large deposit. Number 4, I will not deposit cash or make large deposits of $1,000 or more into my accounts without asking my loan officer. So number 4, if you deposit large deposits, then that money has to be from a viable and legal documentable source. So that's a mouthful, but let me explain further. So large deposit, there's different thresholds, and you want to ask me if the thresholds have changed. But as of right now, at the shooting of this video, the FHA and VA threshold, which those are government loans, it's 1% of the purchase price. For example, if your purchase price was $300,000, then 1% of that is $3,000. So any deposit that's $3,000 or higher will be asked by the underwriter, where did this money come from? And you have to document it with documentation, and it has to be acceptable documentation. So you can ask me about that as well. Now, if it's a conventional loan, currently right now, the large deposit threshold for conventional loans is 1/2 of the qualifying income for the loan. So for example, if the borrowers or the buyers income used to qualify for the loan is $6,000 per month, half of that is $3,000. So again, any deposit that is under $3,000 might be safe. And I say might, and I'll explain in a second, but $3,000 or higher will definitely be asked by the underwriter, where did this deposit come from? And you'll have to show valid and acceptable documentation. Okay, so now I say might because the underwriter can also see patterns. So let's just say if it's $3,000 for the threshold, let's say you deposit a $2,000 check on one day, a $2,000 check on the next day, a $2,000 check on the third day. Okay, you can easily see that $6,000 was deposited. Yeah, they might ask like, hey, I need to see where this came from. Now cash. Now, if it shows up as a cash deposit, sometimes if you deposit cash through an ATM, it shows up as $300 cash. Then if it clearly says cash on the statement or the transaction history, that's not going to be usable in a real estate transaction because you cannot source cash. We don't know where it came from. You can tell us where it came from. I believe you. Always, I'll believe you. But the underwriter won't. So it has to be sourced. It has to be documented where it came from. And a letter from you saying, oh, that cash came from this, that's not good enough. It has to be really traceable money. Now, some examples of traceable money are your paychecks. If it shows direct deposit from your employer, you're good. That's very easily sourceable. Plus you have a pay stub to match the amount there, you're good. If it was a tax refund from the IRS, it shows as a direct deposit, IRS payment, you're good. Same with, unemployment income. It's very, very traceable. You can pull a printout from the unemployment website. That's very traceable. Now, if it's a check, then we'll need an image of the check, a copy of the check, and then documentation where it came from. If you sold your car, then we need a bill of sale with the VIN number on it, the date of the sale, the amount you sold it for, and we need a copy of the check from the seller. They might ask to see the title that was transferred, but they might not. But that's part of selling a car. You would transfer title to that person. If you sold furniture, yeah, I sold this furniture. There's a bill of sale. There's a check from the sellers. It's deposited into my account, and you can show me statements to show it. So you're good. Now here's the statement. Well, I'll get into the statement documentation in the anti-money laundering law video because that's kind of complicated. But, just ask me, have a conversation with me, and I'll guide you through it. Number 5, I will not transfer money between my accounts without first consulting my loan officer. Okay, when you transfer money between accounts, we need documentation to see where it came from and where it went to. So the money that went out and the money that came in. So we need in and out of all accounts. So for example, if you transfer from a savings account into your checking account, we need 2 months of official bank statements for the savings account and 2 months official bank statements for the checking account. And we have to see the transfer out of the savings into the checking. Now, if you've done transfers after the statements have been generated, then you'll need to show transaction history printouts from your bank's website. And I go into more detail in the anti-money laundering law video. But, so we need 2 months from each of your accounts plus transaction histories showing the in and out of these transfers. And And if it's from a donor, so if it's gift funds from a donor, then we need 1 month. We might need 1 month bank statement, depending on what type of loan you're doing. So ask me about that. But you could need 1 full month of the donor's account. So, if it's a gift fund from uncle, then we need uncle's 1 month bank statement. And we need to see the transfer out of his account. And then we need your statement going into your account. But if he does the transfer after his monthly statement has been generated, then he'll need to show 2 things: the 1 month statement showing that he's the owner, because it has his name, address, account number, that kind of stuff on it, and the bank's name and logo usually. And number 2, we need a transaction history print with no gaps in date. So I just tell people, give me the last 30 days, because it's going to be some overlap with the statement, because there can't be any gaps. So we need a transaction history printout showing the money left his account, and on that same date or around that same date, we saw the money going into your account for the same amount. And then we need a gift letter, of course. And I'll repeat some of this on the anti-money laundering law video. But it is a very important and commonly used practice to use gift funds for the down payment or cash needed to close for a loan. Okay, so now I had a situation where a coworker in my office, we're still on number 5 here. So he got, the underwriter looked at his bank statement and saw that there was a large deposit that was over the large deposit threshold. And they said, okay, show me where this came from. Well, it came from my uncle, because, so it was a gift. Well, yeah, I guess. Yeah, yes. During a real estate transaction, if you get money that came from a relative, it's a gift. So we got to document that with a gift letter. And then we need the statement from uncle showing that money came out. So then we got uncle's statement. And then, hey, in this statement, we see a transfer that's a large deposit coming from somewhere else. Account ending in 1234. What is account 1234? Oh, that's uncle's savings account. Okay, guess what? We need the statement from uncle's savings account. We get that. Guess what? There's another large deposit coming from account 5678. Okay, who's got 5678? Oh, that's from cousin. Guess what? Now we need cousins, and we need a cousin gift letter. And it became quite a mess. So basically, if you can avoid the transfers, talk to me about it first. I'll tell you the best way to handle it. My goal, there's already so much paperwork in this transaction. It's going to drive you crazy. You're going to ask me, would you like a fluid sample as well? Because I get that all the time, because it's quite intrusive, the documentation. So let's try to limit the documentation as much as we can, and so we don't delay the closing or disqualify you for the loan. All right, now we can move on to number 6. Number 6, you will not take cash advances from credit or use cash for the down payment or cash to close. So we're being redundant with the cash thing. You can't use unsourceable money in the transaction, but cash advance, you cannot use unsecured debt to buy a home. So, and qualify for a loan. I guess you could if you were paying cash for the house, I suppose. But if you're trying to get a mortgage loan, either through conventional means or FHA or VA or USDA, you cannot use cash from unsecured debt. So, however, you can use cash from secured debt, but there's some pitfalls there too. So you can use money from a home equity line of credit, because that's secured by a different home, but there's a monthly minimum payment that will be counted against you as part of your debt to income ratio. Let's say you have a car that's free and clear, and let's say that car is worth $10,000. You can go to a bank and get a loan for about $10,000 or more, actually, and use that money for your down payment or your cash to close for the house. However, there's going to be a pretty high monthly payment, several $100 or a few $100s. So that will be used against you on your debt to income ratio. So as long as your income supports it, it is possible. But again, we need documentation about the loan and the monthly payment and the balance and all that stuff. So just have a conversation about cash to close and down payment. I would not have pre-approved you if we didn't discuss where it was coming from. But you cannot take a cash advance from a credit card or use any unsecured debt as part of your real estate transaction. Number 7, you will not refinance the loan until 8 months have passed and you've made 6 on-time payments. Again, the penalty on this is huge. It's large. It's a few $1,000s. Average is about $5,000. Let's just try to avoid that altogether. It affects, it affects a lot of people. Okay, but because I coach people on this and because you signed this form, I haven't had a problem with it. But just know that, let's have a conversation about your plans. If you're planning on selling the house or buying it, fixing it and flipping it, then we'll talk about that and we'll talk about timeframes. But refinancing it, we'll have a discussion about timelines on that. Okay, let's go on to the second half. Number 1 on the will. So you will pay your earnest money using a check or EFT from an account that I approve. So the down payment or the earnest money has to be sourced. And if you use a check, take a picture of the check, or else you can wait till it clears and then you can get an image from your online bank of the image of the check that you wrote and show that it has cleared. If it's an EFT, which is a very common way, or ACH transaction, which is the electronic methods of paying the earnest money, then your real estate agent will give you the clearance that the money has cleared, and we'll need to see that money leaving your bank account. So you have to show documentation from the account that I have approved, showing that the money has left your account. Number 2, well, okay, back to number 1, just real quick story. Somebody used they said that they used cash, but it was actually a cashier's check. So it was so they used cash. They brought a chunk of cash. I think it was like $5,000. They brought a chunk of cash to the bank, got a cashier's check, and used that to pay the earnest money. So it was not a good thing because we cannot source the cash. The bank statement did not show that the $5,000 left their account from verifiable funds. So we basically had to do something called backing out the earnest money. It is possible, but the buyer, basically the way we treated it, we treat it like the transaction never happened, like the earnest money never got paid. Because if you don't pay it from a verifiable, sourceable, income, then we can't use it. It did not get paid. So basically, she had to pay it again. She'll get the refund at the closing, but she had to come up with an additional $5,000 prior to the closing and basically pay the earnest money again. Now we waited until the closing to pay it, but she had to prove to the underwriter that she had sourceable income or sourceable money prior to the closing in order to close. And then she got the refund back at closing, but it's kind of a mess. Talk to me, make sure you're paying your earnest money using a check or EFT from an account that I have already approved. All right, now we can go to number 2. You will pay your debt obligations on time. That's probably the most common sense out of all of these. Make sure you're paying your minimum payments. That's going to keep your credit score going well, and it will keep you approved for the loan. I did. Actually, it was kind of sad. I had a story recently where he was trying to do a cash out refinance on FHA. He was going from a high interest rate down to a low interest rate. He was going to consolidate a bunch of his debt. He was going to drop his monthly payments down by $1,300 per month. That means he would have had an extra $1,300 of cushion per month. Like, like that's how much I was saving him from the refinance. However, he was late on a mortgage payment 1 month before we were supposed to close. It was after I approved him for the loan. He missed his payment. 2 months later, we had to wait because there was some appraisal things and whatever. But yeah, it's really sad. So currently the rules say you cannot do a cash out refinance on an FHA loan unless you have zero late mortgage payments in the previous 12 months. So now he has to wait 11 months, basically. It's kind of sad. And, we can't qualify him unless he consolidates all of those debts. But yeah, so don't do that. And there's other stories too. That's just the most recent one. But yeah, don't do number 2. Or make sure you do number 2, rather. Make sure you're paying on time. Number 3, you will submit all documents within 72 hours. That's just to keep the timeline going. Yeah, there's stories where people would drag their feet on stuff and can't find stuff, but then they don't get help either. I'm here to help you if you can't find a document that we ask for, and I'll guide you on where to go, who to call to get it. But yeah, we don't want to miss any closing dates or lose interest rate locks, because those locks have an expiration date. We don't want to do that. Number 4, you will e-sign all disclosures before 4 days prior to closing. Yes. That way we can send the closing disclosure after all the loan disclosures have been signed, and then that's important because the closing disclosure, after you sign that, we have to wait 3 business days and then you can go to closing. So yeah, situation, not my client. It affected my client. So my client was selling their house and buying a new house. The buyers that were buying his house, their loan officer was 1 day late on having the closing disclosure signed. And actually, no, it wasn't even, well, everything's the loan officer's fault though, right? He maybe didn't tell them they needed to sign it today. So he sent the closing disclosure on time, but the buyers didn't sign it till the next day. So maybe he didn't make it super clear, or maybe the loan officer couldn't reach him. I mean, that's possible, but make sure that you are in communication with me and I know how to get a hold of you in case we need to. But if you know this is coming up, you can count on a calendar how many days is 3 business days before your closing. Make sure you sign the closing disclosure. So in that story, they ended up closing a day late. So not the biggest deal in the world, but well, it kind of is. It affected moving trucks, moving people, painters, cleaners, all this stuff. So number 6, make sure you keep your jobs. I had a situation where someone had 2 jobs. They decided to quit one, did not tell me about it until after. Yeah, dropped his income, basically cut his income in half. We were able to recover. It did delay the closing. I mean, it's a miracle that we recovered. So, I'm Joel Miracle Man, but it was a lot of stress. So don't do that. Talk to me about it first. And make sure you keep your current hours worked per paycheck. If you drop down in hours, the underwriter will notice that, or might notice that, should notice that, and will ask you what happened. Did your employment change? Did you go from full-time to part-time? Did you go from full-time to seasonal? What happened? So, and just know that they will verify your employment up to 1 day before your closing. Number 7, you will keep your current credit balances at the same level as when we pulled, or lower, which is improved. So do not charge more on your credit cards. And remember that they will check your credit one day before closing. They're going to check to see if you've had anyone pull your credit. They're going to see if you've opened any new loans and if your credit balances are higher. I had a situation where he didn't add new credit because I told him not to, but he started living on his credit cards more, started racking up the balances. He started maxing out some of his cards, um, and the underwriter saw that before closing, and they said, we have to pull a new credit score because the credit balances are higher. So when your credit balances are higher, your score is going to go down. So we were still able to close and qualify him, but his deal was not as good. He had to pay extra in PMI because PMI is credit score driven on a conventional loan. Yeah, it was kind of scary. He got a worse interest rate, so interest rate can also affect the pricing on your interest rate. So, yeah, look at my episode 3 to talk, I can talk more about pricing on interest rates, but yeah, so it definitely affected his loan for the worse. So don't do that. And it's very possible that if it, we were lucky that we were able to close, but it's very possible that he would not have closed and he would have been disqualified. All right, so that is my 7x7 oath. If you do these, then you'll sign below acknowledging that you've seen these guidelines, reviewed these guidelines, and you know that violating or breaking one of them can cause declines to your loan or cause delays. And with each delay, that can cost you money. The seller might need to rent a hotel or something and can charge you for that, or try to charge you for that, or try to back out of the deal if you don't pay that. So it's just better to follow these guidelines so you have a smooth process. And please ask questions. I'm here to help you. Ask me questions along the way. And that's what I will guide you through this complex process and try to make it as smooth as possible. But thanks for watching, and I hope you all have successful loan closings in the future. Bye.